Market volatility continues with yet another bull market within a bear market just over the last week. I'm not going to go along with the hype, instead I'm keeping to my defensive strategy, and this is the next of my series of videos outlining how I'm positioning my portfolio to achieve this and offset the risk of a recession. In this video I'm going to explain why I think the healthcare industry is a safe bet and my top 3 healthcare companies for investors looking for some defensive positioning. Here we go. The market has continued to be unpredictable as we go through earnings season, where banks and energy stocks seem to be faring well against the backdrop of missed earnings reports from market-leading growth stocks. But as the market has seen another rally, this has given more reasons for the Fed to dish out further punishment, pretty much guaranteeing another rate hike in December. That's why my strategy is to focus on industries likely to be resistant to downturns in the market, and healthcare is just that, as even in a recession, healthcare demand isn't going away. In fact, it's likely to rise. The latest data from the Department of Economic and Social Affairs shows that world average life expectancy has grown to around 75 years and is projected to increase further, meaning a greater proportion of the population requiring treatment of their various chronic health conditions, which presents a public health crisis. As people struggle with the growing cost of living, this can increase health problems. Data from the Health Foundation shows that people unable to afford a good standard of living are twice as likely to be in less than good health. It's a morbid thought, but it's realistic and shows why healthcare demand will continue to grow. And financially, with many patients using insurance, the Affordable Care Act in the US and the NHS in the UK, there are many such examples of why the majority cost of treatments are covered and patients tend to be less price sensitive than they would be in the retail market, where it's clear we are seeing a downturn. Day traders often focus on drug companies, tracking every new drug, treatment and FDA approval, and this might score some wins every time a drug company blows up. But this trading style can be risky and volatile, requiring a high level of dedication to the industry that I'm not prepared to give when I have interest in other areas. However, I'm also not interested in companies that have been pumped up over a single product, such as how many drug companies grew over their COVID treatments and are now seeing a downturn. Instead, my defensive strategy is targeting companies who are generating consistent profits and returns to investors over the long term. So that's why I've been identifying drug and healthcare companies with a history of consistent performance, sustainability and growth, with a long-term outlook of stability for investors over tough times, and I've narrowed it down to the top 3 companies offering the best opportunities for investors.
3.
One company that seems to have taken a massive ride over the last year is Eli Lilly, who discover, develop and markets human pharmaceuticals worldwide, made famous by products such as Prozac, insulin and the mass production of the polio vaccine. The stock has outperformed the competition, climbing 41.97% over the last year and almost 315% over the last 5 years, particularly over the pandemic where it doubled its stock price and proved recession-proof, largely thanks to dependable and growing returns from a long-standing range of products, securing them a 24.7% profit margin on $24.5 billion of revenue. Earnings are expected to grow 21.89% over the next year, outperforming the US market and the healthcare industry in general, which grows at 10% a year. The company hit over 22 billion gross profit on a trailing 12-month basis, which is a 42.84% increase over the last 5 years. In addition, the company offers a generous dividend yield, which has been increasing rapidly to the current 1.15%, which is great news for investors who love a dividend. However, other aspects of the financials are more concerning. Net income has been coming down over the last few years, and this has had a similar impact on earnings per share. The company has been taking on increasing levels of debt and having falling levels of cash, particularly in 2018 when the company acquired Loxo Oncology for $8 billion, which took the debt-equity ratio to an all-time high, although this has been recovering. By these fundamentals, the stock is a massive premium to its peers, trading at 54 times earnings, 10 times sales, 38 times book, and a PEG ratio of 2.05. Yet the stock continues to climb, and a significant reason for this is their most recent diabetic drug treatment.
Here comes the science.
The human brain has various receptors, including one which detects how much food has been digested and signals the release of GLP-1, a hormone found in various organs which stimulates insulin release and inhibits glucagon release, preparing the body to digest food and lowers blood glucose levels. Over the last 15 years, various drugs have been produced to try and increase GLP-1 activity, in turn increasing insulin levels, Eli Lilly's latest drug is tirzepatide, marketed as Mounjaro, a once-a-week user-friendly injection that is touted as the first new class of diabetes medication in nearly a decade. As unlike current drugs, it activates both insulin secretors, GLP-1 and GIP, being the first and only drug offering this dual function to be approved by the FDA. Although successful in improving glycemic control and lowering appetite in patients, they have also experienced a 14 to 21% drop in body weight, suggesting it has the potential to be one of the most effective weight control drugs to come to market. However, although Mounjaro has been authorized as a diabetes treatment, authorization as a weight loss treatment is a complex issue due to clinical trials required to determine its viability in this way. The FDA has granted fast-track designation for investigating its use as a treatment for obesity and other weight-related health issues, but the second part of its phase 3 trials won't be completed until April 2023, and 6 months in this market is a long and risky time to be holding a pumped-up stock. With around 84% of the company owned by institutional investors, the top 11 of which own just over half the company, this shows a great deal of support, but their large-scale influence also represents a high degree of risk to investors should they decide to sell on a high. In quarter 2, Lilly missed expectations with earnings per share short by 28% and sales dropped by 4%, and the company lowered its earnings outlook, disappointing investors and sending the stock crumbling. With the stock at a peak of a rally and quarter 3 earnings due out on November 1st, this may fail to justify the current price, and I'm not prepared to jump on the hype train when they may see another correction. Not when I have better price alternatives.
2.
Next on my list, Johnson & Johnson, the largest pharmaceutical company in the USA by market cap, developing and manufacturing various products in the healthcare field worldwide. Revenue and net income have been shown decent long-term growth, and gross profit is climbing nicely, particularly over the pandemic, helped in no small part by their one-shot COVID vaccine, which saw $2.4 billion in sales in 2021 and expected to hit $3 to $3.5 billion in 2022. But sales have cooled off, with vaccine sales reaching just $457 million, short of Wall Street expectations of $785 million. Due to vaccine sales, J&J reduced their projections to around $95 billion for 2022, with a broad EPS range of 10.60 to 10.80, but over the year, they have continued to beat analyst expectations, with quarter 3 earnings reporting $23.8 billion in sales, a 1.9% increase, with earnings hitting $1.68 a share. That's over 22% growth. Trading 12-month revenue is already surpassing the projection with $96 billion so far, and net income represents almost 20% profit margin. So J&J have revised their guidance with a more precise EPS projection of 10.70 to 10.75, and they announced a $5 billion share repurchase program back in September. Consumer Health has performed well, credited to recovery in supply constraints, price actions and market growth, despite suspending the sale of personal care products in Russia. Fuck you, Putin! The pharmaceutical division has continued strong growth thanks to their oncology, immunology and neuroscience products. MedTech, which represents the focus of their research and development, and that's $10.8 billion spent year to date, has shown great results, particularly with interventional solutions that includes life-saving measures for heart and neurovascular conditions. In addition, J&J have been growing a solid cash position over the last few years, almost a 30% increase in 1.5 years to over $32 billion. And although debt has been rising, growth in shareholder equity has remained strong, maintaining a reasonable debt-to-equity ratio. Add on a dividend that has not only grown consistently over the last 10 years, but J&J have shown solid dividend growth for 50 years, and at current price, that's a yield of 2.68%, and great news to investors who love a dividend. Despite company performance and growth, the stock has underperformed the market, growing just 18.99% over the last 5 years. It's not likely to change with their latest projections, where they expect higher production costs in 2022 and inflationary pressures in 2023 to impact results next year. They've conceded that cuts to the workforce may be necessary to overcome this, and their planned separation of its consumer health business to form a spin-off called Kenvue is not a name I like, but they couldn't exactly call both companies Johnson. The idea is that the remaining company will concentrate on the more profitable, although riskier, pharmaceuticals and medical segments. with CFO Joseph Walk explaining how this is a tactic to prepare for a recession by refocusing resources in a more effective manner, while CEO Joaquin Dito has pointed to their Q3 earnings as evidence of their strong business model. J&J has shown resilience, consistent growth and performance, but continue to give modest projections, which has given them room to beat analyst expectations when it matters and help make them one of the least volatile stocks on the US market. Trading at 24 times earnings, 4.79 times sales, and a PEG ratio of 3.82, the stock is at a premium. But considering their strong cash position, reliable sales, and generous dividend, they will likely hold up well against the negative effects of a recession and provide a decent safe haven for investors.
1.
Our last healthcare provider is CVS Health, a healthcare chain founded in 1963, providing various services in the US such as health and wellness, pharmacy, prescription, insurance, and virtual care. The company has seen a rapid growth in revenue and net income, hitting $307 billion versus $8 billion net income to shareholders over the last 12 months, and recent quarters show the company isn't slowing down. One of the reasons for the company's massive growth is their history of mergers and acquisitions of rivals, which started back in the 1980s and has only become more aggressive over the decades, particularly in 2018, which saw a $69 billion merger with Aetna, the biggest healthcare merger in US history, that led the company to focus less on their retail business and more on healthcare, such as medical services and prescription drugs. They launched their Health Hub strategy, replacing store space occupied by lower selling products such as greeting cards with healthcare services such as yoga classes and the introduction of their Minute Clinics for accessible healthcare assessments. More than 50% of the US population now live within 10 miles of a Minute Clinic. However, in November 2021, the company announced they would be closing 900 of their stores, that's 10%, across the US over the next 3 years, to adapt to changing consumer behaviour. The following month, they announced a partnership with Microsoft to improve their personalized care and digital health services. Last September, they reached an agreement to buy at-home health company Signify Health for $8 billion as part of their expansion on their home services. That plan also includes moving into primary care by the end of the year, a plan which includes placing doctors in up to 350 of their retail pharmacies. This segment of the healthcare industry could be highly disruptive, where avoiding hospital visits are preferable for patients and offer career options to medical professionals suffering burnout from working hospital shifts during COVID, a means of providing a more focused and cost-effective healthcare service where Walgreens and United Health have already had some success. The company has a high amount of debt, notably high during the Aetna acquisition in 2018, but this has been coming down rapidly since, whilst at the same time they have been growing cash at a substantial rate. Weighing this against an increase in assets and shareholder equity shows CVS has been making significant improvements to their balance sheet. Being almost the smallest of the group by market cap, CVS has shown tremendous growth in earnings and cash whilst they pay down debt and continue to expand in the industry. The stock has climbed 5.75% over the last year, and that's 34.4% over the last 5 years, expanding rapidly over the pandemic. Comparing the fundamentals of the group, CVS is a bargain, trading at 15 times earnings, 40 times sales, 1.61 times book, and a PEG ratio of 1.32. Plus, they offer a stable 2.37% dividend yield, which is great news to investors who love a dividend. Where CVS stock may have come down from its February high of $109, the stock seems to have found support around the $90 mark, where analysts are expecting a growth of around 28.8% over the next year. So at $92 is an adequate buying opportunity to build a position to run into next year. As a follow-up to my defensive strategy, I'll reiterate that my goal is to find long-standing, profitable companies with growing cash positions and resilience that will protect my investment over a recession. Healthcare demand is likely to continue rising, recession or not, and where innovations and FDA announcements may create opportunities for short-term gains out of the stock, that relies on volatility. And in an economic downturn, companies with a more solidified foundation of products and services will provide a more stable investment. I've gone over the data for many healthcare companies that meet my criteria, but as time is a factor, I focused on my top 3. Eli Lilly is on a high from recent news and could climb higher, but could also suffer a correction on their next earnings. J&J is resilient, growing cash and delivering results, but as much as the stock is more stable, it is underperforming the market. CVS is the smallest of the group with the lowest profit margin, but are expected to have substantial growth over the next year, providing a more optimistic outcome if you can tolerate a little bit of risk and patience. I've personally been buying CVS and I'll continue to grow my position over the next few months to take advantage of any dips. I prefer their growth prospects and low fundamentals so I can buy and hold for years, not having to adjust my position on response to short-term news. I've been condensing my portfolio to bring it in line with my defensive strategy, including focusing on energy companies mentioned in my previous video. And although it isn't ideal to be so concentrated, these companies are delivering results and turning my portfolio back into the green.
Winner, winning. Winning. Wow, winning. Winning.
If you own one of these stocks or think there's one I should be looking at, or a strategy of your own, I'd like to hear about it. So comment below and let me know. And if you like what you see and you want to see more, remember to smash that like button and subscribe so you don't miss out. Until next time.